You'd think that the COVID pandemic or 13 interest rate rises would dampen the value of our dwellings. Largely, that hasn't happened. We really have a housing market with a small economy attached. Our houses and apartments are worth more than $10 trillion, more than 4 times as much as the combined value of the 500 biggest listed companies in Australia. That index of the 500, the All Ordinaries, largely went sideways today, just below the 8,000-point mark it smashed for the first time last week. The reason is the world is waiting to find out what happened to consumer prices in the US. That data comes out shortly and it informs what the inflation rate is, and that will let us know if the US Central Bank, the Fed, is more likely to cut their interest rates soon. If they do, there's a cascading impact as money becomes a bit cheaper. Currencies basically stood still as markets await that piece of the puzzle, while the value of iron ore, which gets turned into steel, slumped on news of disappointing demand from our biggest customer, China. And Reserve Bank figures have revealed households paid $3.3 billion in fees last financial year, businesses another $10 billion. For every person in the nation, that $124 in fees on personal accounts. But it's really much more than that, because businesses either pass on the fees in increased costs to customers, or they reduce profits and returns to the owners and shareholders. So the next time our highly protected banks crow about their billion-dollar profits, it was you what did it. And that's finance.